Are you a loan officer that helps people buy homes? Especially, do you help people who rent and you say to them, stop throwing your money away each month and start building equity in your home? Then the question that I have for you is, why are you throwing money away and not building equity and instead doing it in someone else's business? It's time to talk about another real wealth divide in our country, which is W 2 employee income versus business owner income. Because if you're still only cashing in commission checks, you might be missing the exact same thing that the renters you're talking to and that you're preaching about this to. And we're going to talk about ownership equity. So today I'm going to break down 5 reasons loan officers who become business owners, how they grow way more wealth than loan officers that remain W 2 employees or even 1099 contractors, and why it might be time to bet on yourself and get better information. And here's the one thing: no one ever talks about this subject. And the way that loan officers can save, because it's complicated, right? And it adds up over the years and it creates a divide that leads to financial freedom. Business owners have 4 times the wealth as a W 2 employee. So if you're new to this channel, I'm Megan Marsh. I am the one of the founders of Collab, and I'm the CEO of Collab Lending Franchise and Mortgage Broker Concierge. So let's dig into what I'm talking about, which the first thing, let's just talk about W 2 income versus business income. W 2 employees have a ceiling. You clock in, right? You do a job, you get a paycheck, it reflects, it's a fixed value. The whole thing is taxed. So let's say you're making $200,000 at a mortgage company. After taxes, that number shrinks pretty fast, and you still have limited control over how your income is taxed and how much you take home. It's subject to what the taxes are. You might get bonuses, and even more comes out. But it doesn't work the same way when you own the business. So let's compare that to someone who's going to get 200,000 and they own the business. They're paying themselves differently. They pay themselves a smaller salary, then they pay distributions, they write off legitimate business expenses like traveling, marketing, office space, maybe a vehicle, and they're walking away with more cash to spend after making and closing the same amount of business. So the income might look the same on paper, but the structure is what sets business owners' income apart. One is taxed at the highest possible rate, and the other has some flexibility and strategy to maneuver within it. For the second piece, let's talk about equity, because equity is a game changer. And I didn't even realize it until I sold my portion of my mortgage business. So, just like homeownership builds wealth through equity in the home that you own, business owners build wealth through the business that they've built. When someone else wants to come in and plug into that system and earn the income that you have built through your business. Now, don't get me wrong, you can earn great W 2 income, but at the end of the day, there's no asset that you can show for it. It's just when you work, you trade time for money. You can't sell your job, but as a business owner, your company is an asset that if you set it up the right way, someone does want to own that asset. You're not just making money, you're building something that can grow in value, operate without you, and even be sold one day. And we're seeing more people in the mortgage broker space get offers on their business. Loan officers, this is no different than what you tell people who rent. Hey, you can rent, and every month you can pay rent, but you don't earn any equity. And so when you think about your business, if you've grown a nice book of business, it's time to start thinking about this and the long-term implications. Now, this didn't click for me until it was time for me to step out of my mortgage brokerage and do what I do now, which is help people open their own brokerages. And I needed to see it to really understand it and for it to process. What happened was we went through this process of valuing our company, of how much it was worth based on what mortgage companies typically sold for. And what happened was the first 5% of my equity was sold, and I walked away with a check for around $50,000 for just 5% equity. And I nearly choked that, oh my gosh, I still am going to be selling another 45%. I didn't even think about this piece of the business I've been building. And I think about all of the loan officers in our industry who take sign on bonuses for amounts like that maybe once, whereas you could be building your business over your career lifetime, pass it on to your team, pass it on to your children, and create income for yourself after you're no longer doing loans. Then number 3, probably my favorite one, the wealth killer for W-2 employees, which is taxes. So let's talk taxes, because this is where business owners really pull ahead when they are advised and take the right actions when it comes to the taxes that you pay to Uncle Sam. So a W-2 employee, someone who earns all their income through W-2, they pay taxes on their gross income before any expenses. So let's say you make $200,000. You could easily pay anywhere from $50,000 to $70,000 in federal, state, Social Security, and Medicare taxes. Meanwhile, a business owner with $200,000 in earnings can pay themselves differently. They can pay maybe a $60,000 salary, take the rest as distributions, write things off. And through writing things off like travel, vehicle mileage, the whole vehicle, the home office, meals, entertainment, the list goes on. This is the hidden engine of wealth. You're not just keeping more, you're redirecting dollars into other things like investments, expansion, legacy building. Now, I calculated an example for you to see this because I think it's important to really understand this piece here. So, a loan officer who earns, well, we're just going to use 200,000, even though I strongly believe that as a loan officer, if you're making 200,000 in W-2, if you own the brokerage, you will make more than that take home, but we're going to compare apples to apples here. So a loan officer who earns 200,000 pays around $51,000 in federal, state, and all those taxes. Now, a second loan officer who closes the same business, let's say takes home 200,000, but pays themselves differently, like I mentioned, let's put it, I'm going to put it up here on the screen for you. Let's say instead of having all 200,000 being W-2 income, let's say 60,000 of it is paid through W-2. Then 140 is in distributions. We're going to keep this simple. That loan officer, broker owner, pays 39,700 in taxes. And this is just one piece, the beginning. I haven't even dug into the other areas where they save more and more and more. So you're already over $10,000. I think it's 12, 13,000 in taxes just from one little move. And that is just the beginning. I'm going to actually nerd out on you here, and I'm going to pull up on my screen and compare a W-2 versus a business owner. So I calculated an example for you to see this on my screen. So a loan officer who earns $200,000 in commission that we're going to compare across the board, if they are paid that $200,000 as a W-2 employee, the whole $200,000, roughly their taxes, they're going to have their federal taxes. Then there's also the payroll taxes that come out for a total of $51,065. Yes, that number can change a little based on each person, but we're going to use this across the board. At the side-by-side comparison, someone who is a S Corp business owner can take that $200,000, they can pay themselves a W-2 of $60,000, and then take distributions for the rest of the $200,000 for $140,000. And what that does is it lowers the amount of their federal income taxes, and you can see here, and the payroll taxes. And so the total amount of taxes goes down to $39,707, which means they've saved $11,358 in taxes. That's the simplest form. But then we're going to stack on two other ways that the business owner saves. So you go to the next level. Well, most business owners are going to be writing off expenses that they can't write off when they're an employee. So let's use an example of the same S Corp business owner taking a $60,000 salary, but then they're writing off $25,000 in expenses, which means they only get $115,000 in distributions. We're going to start there because now they're paying $34,380 in taxes, increasing the amount of taxes that they save. But where they make it ahead is over here on the right. So if you look, we've got the take home of each of these scenarios. The take home is the total amount that they've earned minus their taxes paid. Remember, in our first scenario, those same expenses are going to be paid by the W-2 loan officer, but they've got to pay them after taxes. So their total after paying taxes and their expenses is 123 versus the business owner. Even if they write nothing off, they're taking home that extra 11,358. If the business owner is smart, writes the expenses off through the business, then that means now, unlike our first two scenarios, they don't have to pay those expenses a second time. It's already factored in. Now they're taking home 140 versus the W-2 employee taking home and getting the 123 after they've paid expenses. And let's take it even one step further. A business owner, an S-Corp business owner who pays themselves a salary, writes off expenses, they actually don't get taxed on that 115,000. They get what's called a QBI deduction. And that means that 115, that's not what gets taxed. Only 80% of it does. And that makes that the income taxes go down even further. Showing you here where just by being that business owner, being able to write off some expenses, taking that QBI deduction, now you're taking home an extra roughly $20,000. Okay, imagine if you had $20,000 that you never even saw and you invested each year, how much more would you have in net worth at the end of your career? Now, number 4 is freedom of time and scalability. So as a W-2 employee, especially as a loan officer, we are stuck in a cycle of trading time for money. We go out, we get business, we close a loan, we get paid. We take a week off, we lose income because we're not going out and getting business, taking a loan, and getting paid. As a business owner, however, this is where scaling comes in, and it's scaling beyond yourself. You can hire, delegate, automate, and grow even when you're not the one personally producing. You can have people produce your loans. And yes, I know you can do that as a W-2. But really, this is where my business really changed because I didn't have the same, I had to wait for somebody to give me permission where I worked before. Once I owned, I got to decide. And for anybody who says, I don't want to manage people, right? You already are. You manage clients, you manage the lenders, your underwriters, you have someone helping you. And a lot of times you might not even choose some of those people that you're working with. It's just, you're doing it under somebody else's business. So think about if you've been frustrated. Sometimes having the control to pick is worth it. Number 5, real net worth comparison. So let's just talk about those numbers again. So the average net worth of a W-2 employee in the US hovers around $192,000, right? Probably own a home, even for high earners. Probably are homeowners. Now, what's the average net worth of business owners? It's over $1.3 million. And in many cases, it's much higher if they scale and they exit selling their business one day. You don't need to be a genius or start a mortgage company you own necessarily. You just need the right model and the right support and the willingness to take advice and build something that's your own. Either take the foundation that you have and build another type of business, but plug into some type of business structure. Stop renting, start owning something. So if you're a loan officer or mortgage professional, you already have the knowledge, you already have the skills, and you've already started building the network and the client base. You've already done the things that a lot of people do when they build a business. It's time to turn that mirror around because the path to wealth isn't more hustling under someone else's roof. It's figuring out how to do it for yourself. So ask yourself, are you going to keep renting your time? Or are you ready to start building what you really want for the future? If you're curious what that looks like, drop a comment, tell me your questions around ownership, the things that maybe scare you about it or confusions that you've had. And and make sure that you book a discovery, a Q&A call with myself or my team. Otherwise, I will see you guys in next week's video all about mortgages, finances, and real estate.